Welcome to the Purpose-Based Retirement with Certified Financial Planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Good to see you again. I'm Lee Kelso here with Casey Weade, Certified Financial Planner and the President of Howard Bailey Financial. We're going to begin the program today with a segment just for those of you in your 50s who might be a little behind the eight ball and getting ready for retirement. Some real helpful advice is coming right up. And then later in the program, talking with our viewers, including one who has some questions about long-term care insurance. So a lot ahead today. Let's begin, though, by welcoming another guest to the program, Marshall Johnson, also a certified financial planner and the vice president at Howard Bailey.
Hey, Lee.
Good to see you.
Good to see you.
With the concept of being in your 50s and being behind the eight ball is something that I know you're very aware of and you deal with it all the time. And the underlying principle of getting ready really is build that cushion, right? Maximize savings.
Yeah, I think there's a lot of folks that come into our office and they say, you know, I feel a little bit behind the eight ball. I'm in my 50s. I don't feel like I've saved enough. And it's really time, Lee, that we can become a super saver, really take advantage of some of the opportunities that are in front of us. Maybe the kids are out of the house now and the cash flow is a little bit higher. You're in those peak earning years. It's really time to sock it away.
You know, I think there's something very important to point out there, because a lot of the times the folks that I'm sitting down with, and maybe you find it yourself, you're in this position, you're maybe 5-10 years out from retirement. And let's point out, retirement can happen anywhere. Maybe you're 50, maybe you're 40, maybe you're 60 and you're getting ready for retirement. The point is you're relatively close to retirement and you feel like you're a little short on your savings. Maybe you haven't hit that goal that you had always strived to hit. Maybe that's $500,000 saved for retirement, $1 million, $10 million, it doesn't matter. And many times what I find is that we're striving for higher and higher rates of return to get to that goal. We're trying to make 10% a year, 7% next year. We made 30% in 2013, maybe we can make 30% next year, and we start taking on more risk in order to hit that goal. And when in reality, what we should really be focusing on is starting to protect that life savings and maybe getting a little bit more creative, which means finding different ways to save. Maybe additional dollars for retirement and start protecting and repositioning assets so that they're there when we need them to be there, which might be right around the corner.
Right.
We shouldn't be taking too much risk. And a lot of this comes out of not really knowing what that number is in the first place. We're just arbitrarily saving for this figure that's $500,000, $1 million. You need to sit down with a certified financial planner practitioner that can show you what that number is so that you can rest easy for the next few years.
You know, an important element that many people, a goal they have in life is to pay off that mortgage.
Right.
But it's even more important at this point.
You know, it really is, Lee. We talk about lowering our expenses, lowering our overhead, beginning to pay off debt, and that mortgage can be one of those psychological barriers that we just want to be able to get over, know that the roof over our head is secure and paid for. That is a great thing, Casey, to be
debt-free.
To be debt-free, but also there's some opportunities with interest rates today.
You know, and I think that is a great goal. Everybody wants to be debt-free when they get to retirement. It's just not all that realistic for many people that are in this close to retirement. Instead of socking that much money away towards their mortgage, many people are thinking about sometimes even taking money out of their IRAs or 401ks in big lump sums, paying a ton of taxes to pay down that mortgage. And the reality is, in the interest rate environment we're in today, there's nothing wrong with having a 30-year mortgage in retirement as long as you're not taking risk with the money you need to make those mortgage payments, right?
Yeah, good point.
I had this discussion with my dad earlier before the show, and we were talking about he's age 67 and he just refinanced for a 30-year mortgage. You know, so maybe you find yourself, you've got a 4+% rate and you're stepping into retirement. Go ahead and refinance in those low threes that we can possibly get today and have a lower payment, less stress, enjoy those retirement years. Don't feel like you have to be debt-free, but hey, it's a heck of a goal, and if you're young and you're a long ways out, start socking away. Make those double payments. There's nothing wrong with that.
So even if you keep a mortgage, it's very important to get rid of all that consumer debt and be at least debt-free from that side, right?
Yes, let's take care of that variable debt. We talk about interest rates being so low today. One thing we need to watch out for is these interest rates when they rise and the amount of interest that we're going to pay on that's to service that debt, Lee. So get those bills, downsize our lives a little bit, because now we want to start to maximize our cash flow and really figure out how we can step into retirement in the best possible
and sometimes
position.
it's not about eliminating that debt, but consolidating it. Kind of like we had that discussion about the mortgage earlier. I had a couple that I worked with several weeks ago, and when they came in, they were very stressed out by this debt that they had. When we got to that question on our questionnaire about the debt, they had credit cards, they had student loans that they had taken over for their children, and then they also had a home equity line of credit. Well, that whole debt pile added up to about $50,000, not a whole lot, but it was costing them over $1,000 a month when it came to making those payments. You know, what we were able to do, we looked at those payments, we said, well, the home equity line is really a great deal. It was about 3% a year was the mortgage rate, or the home equity line rate, and then they had these student loans and these credit cards that were all double digits. What we were able to do was consolidate those things into the mortgage, have a 30-year mortgage, save them $1,000 a month. Consolidating that debt was a huge relief for them, and it's actually going to allow them to retire now, freeing up $1,000 a month. That's $12,000 a year. How much would we have to have saved to create that same level of income? That's like freeing up $200,000 to $300,000 in retirement savings.
You bet.
Big cash flow.
So taxes and taking advantage of every tax break that you can.
Yep, taxes at age 50, Uncle Sam gets us the catch-up contribution. So we want to make sure that we're digging in, getting that extra dollars in our 401k, about $6,000 a year. Also on IRAs, we can contribute an extra $1,000. And one point there, Casey, is we really want to stress HSA accounts. It's a wonderful program. Make sure you're maximizing your HSA. You're going to be able to get triple benefits in retirement, not just on our contribution, but our gains, be able to use those things tax-free. So I'm even all for funding that HSA before going for the catch-up contribution other places, but just maximizing the plan, right?
I think we're just so caught up with minimizing our taxes today, sometimes we overlook the future at the same time. We're talking about tax minimization, taking advantage of HSAs and 401k contributions and things like that, which are very vital for your retirement to save yourself some money on taxes today. But what are you also thinking about what taxes are going to be like in the future? And sometimes those are things that cause short-term pain for long-term gain. For instance, I had a CPA that I worked with here recently, and when we sat down in our first session, we're sitting down in our first session, they're about 5 years out from retirement, and she's working part-time, he's working full-time, they've got about a $90,000, $100,000 annual income, and she's doing a great job at getting that tax rate down. She's actually got them down. I said, what's your taxable income? She said, oh, our taxable income's around probably $50,000 this year. Well, they've got this big old traditional IRA that they have today, hundreds of thousands of dollars in IRAs that someday they're going to be forced to take distributions out during retirement, and they're going to have to pay taxes on it at least a 15% tax bracket. They've got about $25,000 every single year for the next 5 years that they could be converting part of that IRA to Roth IRA, so that when they get to retirement, they've diversified their tax buckets. It's not all in 1099 and taxable money. It's not all in tax-deferred accounts, but now they have some tax-free money, and this is also going to help them reduce their taxes on their Social Security benefits, because we can take a little bit out of each of these and create this blended retirement income strategy.
You talked about Social Security benefits too, and that's one of them, Lee. Make sure we have a plan for taking Social Security. Don't just check the box and say, hey, it's time for me to start Social Security. Have a plan. This is most folks' greatest resource in retirement. Let's not waste that opportunity. Maximize it, whether it's having a strategy or deferring. Make sure you have that strategy in your 50s too.
And the one last point I know you think is important to make is do all that you can to protect the career from your income from your career.
You know, I can't tell you how many just really sad stories. People that I've met with who are only a few years out from retirement, they're just trying to sock a little bit of money away. They only need to make it 2 or 3, 4 more years before they get to their retirement date, 62, 65, whatever it is, and then all of a sudden they lose their job, whether that be to illness or some other factor. You know, you have to start insulating your work today, because you're in your peak of your earning years most likely, and these next couple of years will never be more important. So make yourself invaluable valuable to that employer so that you don't have to go through some of these things that I've seen other people have to go through.
Well, if you're in your 50s and you're feeling kind of behind the ball a little bit, here's an opportunity I hope you'll take advantage of, and that is an exclusive offer for our viewers. For the next 10 people who call us right now, you're going to receive a complimentary review of your entire financial and retirement plan. It's an opportunity to get an education about your money so you can make the best decisions for yourself moving forward. So for the next 10 callers, Casey and the team at Howard Bailey are willing to make some time on their calendars to visit with you and give you your very own purpose-based retirement. We're back talking to viewers in just a minute.
Hi, I'm Casey Weade, a certified financial planner practitioner and the president of Howard Bailey Financial. Do you feel that your financial professional should put your interests above all else? Well, I do, but Wall Street doesn't. While lobbyists seek to delay a universal fiduciary duty on all retirement accounts across the financial services industry, you can begin working with an advisory team that's ahead of the curve. Don't you want to work with someone who puts your interests ahead of their own? If you said yes, then give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Usually we have some time to take questions from viewers. That's the case today. We're going to start with a question from Sarah right here in Fort Wayne. Sarah, go ahead. Sarah's question was, she purchased some tech stocks back in the 1990s, mostly Amazon, and now she's got huge capital gains. She paid about $20,000 for those positions that are now worth nearly $200,000. Sarah says she's about 10 years out from retirement. She doesn't want to be killed by taxes when she retires. Casey, what suggestions do you have for her on how to handle that potential liability?
Well, Sarah, I'm sorry that you got cut off there. Hopefully we can have you on the show here next weekend. But I think you've got, I think first of all, you've done a great job, and it's something that everybody should learn from. Before we get into the tax liability of things, we can see that someone did what? They bought and they held, right? They followed that age-old methodology of we buy low and we sell high, and that's where she's gotten herself today. Sarah's went from putting away $20,000, and she's been through some rough times with these stocks that she's had, for sure. 20 grand turning into 200, it wasn't a smooth ride. We had the tech bubble, we had 9/11, we had 2008 financial crisis. These stocks have suffered some very severe losses at times, but she had time to go through these big ups and downs and get to where she's at today. And that's something I hope you learn from. If you're young and you've got 20 or 30 years before you get to retirement, there's nothing wrong with buying yourself some good index funds, some good high quality stocks, and holding on to them and not paying a whole lot in fees and expenses, because you'll probably do a lot better than some of the active money managers out there that are buying and selling things on a daily basis. Now back to Sarah's root of her issue here is now she's created a problem. Now it's a good problem because she made money, now she's got to pay taxes. Now that $20,000 turned into $200,000, that's a $180,000 gain. Luckily, it's a capital gain and a long-term capital gain at that. Short-term capital gains will be taxed at your highest marginal tax bracket, while your long-term capital gains are going to be taxed at a preferential rate, like qualified dividends, although it could be at 0%. So that's one thing that you want to take into consideration here, Sarah, or anybody for that matter. If you've got capital gains that are built up in your portfolio over the next couple of years, there's a good chance we see taxes change, and they've already have some proposals out there to make the long-term capital gains rate 25%. And today, Sarah, if you're married, for instance, if you're married and you're in the 15% tax bracket, so all the way up, your income's up to $75,000, you're not going to pay any taxes on your capital gains. Now, if we go to that second level, that's from $75,000 to $466,000, then you're going to have a tax rate of 15% on those long-term capital gains. And then if you're above $466,000 in annual income, well, then that puts you in a 20% flat tax rate above that point of time. Another thing you want to keep in mind is the Medicare surtax that came out of the Obamacare legislation, and that's 3.8%. So that's another level you might want to watch out for that's over $250,000. What I would encourage you to do is probably start to create some gains every single year, start locking those things in. One of the things I talk about so often, we've got a $200,000 stock here, depending on how far you are out from retirement, that $200,000 stock that we have, if we end up paying $180,000, we end up paying $25,000 in taxes or $35,000 in taxes. What percentage is it going to take that stock to lose in order to make up for those taxes that you ended up having to pay? And sometimes it makes sense. Buy low, sell high.
Yeah, Sarah, Casey covered it all there. But the thing I would mention is if she's later in life, if she's in her 80s, you know, maybe we don't want to pay those taxes at all. Maybe this is an asset that we just want to leave to the next generation because she'll get a step up in basis.
Yes.
But from the question,
and I've seen that mistake made in the past.
I took it as if she was younger and needed those assets.
Yeah,
but
10 years out from retirement, probably so.
Yeah.
Guys, let's move ahead to Alan in Wabash. What's your question, Alan?
My wife and I are about 65 years old and looking for some type of long-term care insurance. Our advisor has presented us with options from Genworth and John Hancock, but has been pushing us more towards some type of whole life insurance with long-term care benefits. What are the pros and cons?
Well, there are definitely pros and cons with that, Alan. There's always pros and cons with anything. I think the one thing that's really neat about what your advisor's doing for you is it sounds like he's presenting you or she's presenting you with all of the options and giving you the ability to make the decision for yourself. And what you need to understand is all of your options and the pros and cons of all of those options, because long-term care insurance can be a great solution. Long-term care hybrid products like this whole life product can be a great solution too. We've seen a big transition over the last decade to these hybrid types of products. If we look at how many long-term care policies were sold back in the year 2000, there were about 750,000 long-term care policies sold in the year 2000, and in the year 2015, only 110,000 policies sold. So we've seen a dramatic decrease in the number of traditional long-term care products sold, and we've seen over the last few years, now we've actually had twice as many hybrid policies sold in the year 2015 as traditional long-term care insurance. That's $220,000 policies sold last year. So there are some things that come out as benefits. There must be pros and cons here. The biggest pros are going to be, one, I see it, as you're going to have a fixed amount of premium to pay every year. You're typically guaranteed that premium, so you don't have to worry about those premiums increasing every year like we've seen some carriers like Federated. Federated last year went up by about 100 to 130%. On a lot of people's policies, their premiums doubled altogether. So now you're going to have a fixed policy. You also typically have some kind of cash value or return of premium, so you can have your money back, maybe even with growth. And then you have a death benefit that's going to be left behind to your heirs. The downside of these things are, though, that you are going to have a limited pool of benefits. It may not cover all of your expenses. For instance, if you go with one of these Genworth plans, maybe a partnership program, you can get a partnership plan that's going to offer some true asset protection, and those type of asset protection benefits you're not going to get in these hybrid type policies. You may also get better tax deductibility and better tax benefits with the traditional long-term care. So there's a lot of things to weigh there.
We always are interested in what's on your mind. If you'd like to drop an email, we might give you a call and ask your question right here on the air. You can email info@howardbailey.com. Today, an exclusive offer just for those of you who are watching and our viewing audience right now. For the next 10 people who call just right now, we're going to give you a complimentary financial review of your entire financial and retirement plan. It's an opportunity to get an education about your money because we want you to make the very best decision for yourself moving forward that you possibly can. So for the next 10 callers, Casey and the team at Howard Bailey will make time on their calendars, sit down, visit with you, and give you your very own purpose-based retirement. Let's jump out to our question of the day. At what age are you required to begin making distributions from your retirement accounts? Is that as young as 59 and a half or all the way up to 70 and a half? Casey has the answer and more coming up.
You don't walk into a doctor's office for some blanket prescription for whatever ails you. You expect individualized attention, a doctor who listens, and a treatment prescribed to meet your specific need. When it comes to your financial future, why expect anything less? If you would like an independent checkup from an independent advisor with access to hundreds of possible solutions to help you meet your goals, contact us today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
You do that?
I wouldn't do that.
Casey and I were just talking here off camera about the question of the day. The question was, at what age are you required to begin making distributions from your retirement accounts? We were just discussing about all the data and who is going to present it. And I'll tell you, I'm giving that to Casey.
Well, there's a lot of different numbers here. You have 4 different numbers, and D is actually the answer, 70.5. That first one, 59.5, is when you can avoid 10% penalties as you take distributions from those tax-deferred retirement accounts like your IRAs, potentially even do an in-service rollover while you're working. We had 62, that's an early retirement Social Security date. 65, that's when you first qualify for Medicare. But 70.5, at that point is at which the IRS is going to require you to begin taking distributions from your IRAs, those tax-deferred accounts. Whether you want to take those distributions or not, now you have to start taking those distributions. And that's after the age of 70.5. You can also wait to the year after you turn 70.5, but if you wait, then you have to take 2 distributions, and that's not always the best thing for you to do. And sometimes you most likely want to start spending that money before you get to the point of being 70 or 75 years old. So where should you be taking those funds from? Which accounts? And what we're going to be talking about today is some tax-efficient spending strategies. So you've got these different buckets of money. You've stepped into retirement. You've typically got 3 different buckets. You've got one bucket where we've got our 1099 money, right? Mm-hmm. So we get a 1099 on our gains every single year, our interest and our capital gains or dividends. We get taxed on those funds even though we're not spending them. Then we have this middle bucket here. This middle bucket that we've got right here is our tax-deferred bucket. Our tax-deferred bucket is our IRAs, our 401ks, maybe some tax-qualified annuities, things that are being tax-deferred until we're forced to maybe begin taking distributions like your IRAs and 401ks. Then we've got this last bucket. Now this last bucket that we've got all the way over here is our tax-free bucket. Income tax-free, meaning that when we take distributions from that accounts, we don't have to pay taxes on those things. We paid taxes going in, and now they're growing tax-free until we begin taking distributions. Maybe your Roth IRAs, Roth 401ks, maybe some cash value life insurance. So which one of these different buckets do we spend first? And I'm going to walk you through an example so that you can start to understand which ones are the best ones for you to withdraw from first. Now we've got an example of an individual that's got $1.5 million in their accounts when they've gotten to retirement, and they need $80,000 a year from these accounts in order to generate the retirement income. That's $750,000 in after-tax money and $750,000 in IRA funds. I don't meet too many people that have Roth IRAs because they've been forced to put a lot of those things into 401ks and tax deferral. So this is a pretty normal situation. However, this can be applied to your situation whether you have $700,000 saved for retirement, $2 million, or $20 million. It's an example that can help you start to get a grasp on these things. So the traditional methodology of drawing income during retirement says that we should be spending that brokerage account first and letting that IRA be tax deferred and grow at a higher rate before and take those distributions later. Spend that money last. But what if we were to spend that IRA first? Well, if we spend the IRA first, one of the problems that's creating is now we've got this big old brokerage account that's being taxed on its gains. We're going to have lower annual returns in all likelihood because it's being taxed. So now we've got that IRA, we spend it down first, we're making 8% a year and drawing 4.5% to 5% a year in income and adjusting it for inflation. And at the end of 30 years, we see that we could actually almost run out of our savings. All that we have is that brokerage account. This is going to be the worst possible strategy. And if we look at it another way and we said, well, let's spend the brokerage account first and the IRA last, now at the end of that period of time, instead of having less than $200,000 left, we have about a $1.2 to $1.4 million left in that IRA, a significant difference, largely because of the rate of return difference between the two. But instead, if we spent both of these accounts evenly, this is going to be the best strategy of the 3. Why is that? It's because it's allowing us to maintain a tax bracket, the 15% tax bracket in this example, where if we took the IRA first, we have big taxable distributions on the front end, or if we took it last, we've got big taxable distributions on the back end. Now we can take a blended distribution and keep those distributions lower because we're not paying as much in taxes. If we look at those 3 options, we can see this line here represents spending the IRA first. The orange line represents spending the brokerage account first. And this top line represents spending a withdrawal strategy of about 50-50. So a split withdrawal strategy between the two is going to be the best strategy of the three. But we're not done with giving you some good things to work on at home with yet. What's next is doing a strategy involving a Roth conversion. So let's take that same individual. We're going to spend down that brokerage account first. But while we're spending that brokerage account, we're going to be converting that IRA to Roth IRA and filling our 15% tax bracket every single year. Over 10 to 15 years, we spend down the brokerage account, we eliminate some of the taxes that have built up in the IRA and start creating this big old Roth IRA. Then we can take blended distributions of the Roth IRA and the IRA to maintain that 15% bracket throughout our retirement life. And that will result in the best strategy of these four different options. If we take a look at those lines again, we spend the IRA first, we spend the brokerage first, we do a split withdrawal strategy, spending a little bit of each, or we do some partial Roth conversions over the first 10 or 15 years while we're spending down that brokerage account. We can see how much dramatically better that is. It's about 40 to 50% better than the closest strategy after tax. So, what are some things for you to think about? Well, you have to pay attention to what tax bracket you're in today, first of all. So if today you're in a marginal tax bracket that's relatively high, and later in the future when you take distributions, you'll be in a lower tax bracket, then you may want to think about not withdrawing from that IRA, not doing a Roth conversion. If on the other hand, you're in a currently lower marginal tax bracket and it's going to be higher in the future, whether you want it to be higher or not, then you should probably think about doing some partial Roth conversions. There's a lot of other things for you to think about as well. This is just an example of some of the tax strategies that you and your CPA should be putting in place to make sure that retirement portfolio lasts as long as you do. Other things that we might take into consideration: do you have an emergency fund established? If you spend down that brokerage account, where are you going to get a big chunk of $20,000, $100,000 without paying a bunch of taxes if it's all in your IRA later in your working years? Also, health care. Where are we going to take care of our healthcare expenses later in our lives? All these things have to come together in a comprehensive income strategy. It's not just about taxes. It's not just about investments. It's not just about inflation or healthcare. It's about all these things coming together and having a team that's there by your side to make sure that money lasts for the rest of your life.
Well, you just hit on something there that I think is probably pretty important, and that is, are you working with a team of advisors? I can imagine there are a lot of people at home saying, my investment advisors never talked to me about an income strategy.
Yeah, you know, most investment advisors are focused on just that, investments,
right? Not
the holistic strategy, and that's what it's all about. It's not just all about returns once we get to retirement. We have to be focusing on the heartbeat of our financial life, which is what? That's your 1040, right? That is the heartbeat of your financial life, and that's what's going to assure that, blended with your investments, that's what's going to give you that peace of mind during your working years or your retirement years that you're looking for.
Well, I invite you to take the first step toward that peace of mind, and that is by taking advantage of our special offer today. For the next 10 people who call us right now, we're offering a complimentary financial review of your entire financial and retirement plan. It's that opportunity we talk about so you can make the best decisions for yourself and your family moving forward. So the next 10 callers who dial the number on your screen, Casey and his team will make time to visit with you and give you your very own purpose-based retirement. Of course, you can always get in touch with Casey and the team at howardbailey.com, and we will see you next week.